Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. I wish you all a very happy and colorful Holi. While we're celebrating colors in life, a lot of investors are grappling with too much red in their portfolios. So, what should you do about it? Should you actually do anything about it? That's exactly what we'll talk about with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
First of all, the markets are in the red. Why is it happening after a spectacular bull run? Since October 2024, the markets have only been going down. So why is this happening?
There are many reasons for this, and they are well anticipated, or they were expected, and they are actually unfolding. Or I can give you, I can call them excuses for the market fall. One is that the Fed rate cuts, that was the starting point. Fed rate cuts, FI is pulling back from India, or they're taking money out. Crude oil prices, we have, but nothing is new. So, and then the change geopolitics, particularly after the American election results, we know that everything is up in air. Everything is, everybody is anxious about it, what is in store for us or what is in store for them, the greater uncertainty. And that uncertainty is unprecedented today on a global basis, the geopolitics of it. Domestic factors, market was expensive. Earnings slow down because if earnings can't really keep pace at the same rate, then the market looks expensive. Then besides that, we were expecting that, the current government that we have, it was expected that it will get a majority. It did not get a majority. That was the initial blip or, blow to in a limited way. And then, we have different sectors which will be affected by the changing geopolitics, the different tariff and other things. So, variety of reasons, lot of concerns. But none of it is a surprise.
You say,
and we haven't had a calamity.
Yeah. So, you said that it was all anticipated, none of it is a surprise. Would you call this a healthy correction or there's a deeper trouble that it's signaling?
I don't know. The reasons are so well spread of their variety. They are a wide variety, and I don't think one can do much about it. One cannot do much about it because one should look at how much have you made in the last 3-4 years, and is it and corrections are an inevitable part of the equity market. Equity market, when we say that it is going to give you 18%, 20%, 15%, or 12% return every year, or have the long-term return from equity has been that, then it is not that it is a 12% yielding fixed deposit. It is not a 18% yielding fixed deposit. This 18% is an average of many negative, minus 20%, minus 50%, minus 10%. And then some years where it is 100%, 120%, 80%, the way we saw it last year. So if you look at this, and it is extremely difficult for people to time it perfectly. And when we are in the middle of a phase like this, it is nearly impossible to get out of it in time. And then on board again, because the real problem is that if you are able to get out in a very timed fashion, then you will have the false, it is generally because, you have some belief and mostly, and a great amount of luck. Because you don't get a clear signal that, okay, now the market is at a stage and you have a formula which is saying that get out now. It is not like a fire and an alarm bell that, get out in 5 minutes, else you'll be trapped. So what happens is, and once you get out, it's impossible to get in again. Because when you are at the trough, when you are at the low, then there's a problem. You never know, because the fall is always very sharp and it is steady. You don't know when it will actually make a comeback. And it's very difficult to perfectly time the lows as well. Yeah. So I would say that corrections are always disappointing. And they are healthy from a market perspective, that they are able to, moderate, it for a long-term investor, it creates a great opportunity that if you are doing your SIP, I'll feel happy that, the markets have corrected. Markets are at a lower level. I'm able to buy more for the same money. And that, I think, is the key thing. Corrections are healthy from that point of view. But corrections are always disappointing because psychologically we feel that, okay, I had 50 lakh rupees, now it is only worth 40 lakh rupees and I did nothing. I wish I could have taken that money out on January 1st or some such thing. But it's impossible to do it.
Right now, So, with keeping in mind the state of the market, how can investors ensure that their portfolio is as vibrant or balanced as a colorful Holi palette?
For most investors, it is always disappointing. You cannot really curtail. Even a very long-term investor who doesn't need the money for next 20 years, he also dislikes or hates that okay, market has gone down by 10% or 20% or 15%. But you have the same rules which you have to apply. One is that make sure that it is your long-term money. That is the first premise. That is the first thing. Second is that never invest in equity at one go.
Right.
Because the moment you do it, if anybody would have invested 1 crore of rupees in January, as compared to somebody who is spreading that same money, 1 crore rupee, as 5 lakh rupees every month for next 20 months, that guy will feel, the second guy will feel happy. And that is joy. Initial phases you will have regret that I wish I had invested if the market was going up, because you'll see the right tide up as well. But it's very difficult to formulate your own principles. Third is that don't get attracted to a narrow segment of the market. Soon before this correction really is gaining momentum. Before that, we saw that large number of the narrow sectoral fund, thematic fund, PSU fund, EV fund, this and that, and most investors get attracted to it, and it's generally the wrong time. It is normally those funds get created which has done very well in recent past, and that generally is the most expensive segment of the market. And when it becomes very expensive, that is when these funds actually strike a chord with the consumer, because mutual fund at a certain level is a consumer product. It is being sold as a story, and that is a hot selling story. People get carried by that, so don't do that. And then once you have something meaningful, keep a part of it in fixed income, because that is how you will be able to capitalize little more on these benefit and profit from these corrections. So long-term money, diversification, not getting attracted to a narrow segment of the market, and then rebalancing.
All right. For someone who has been investing but his portfolio is deep in the red, what would be your piece of advice to that person? And what is it that they should hold? What is it that they should sell?
I would broadly like to classify investors into 2-3 categories. Somebody who started 4 months back and started his SIP, he should simply carry on. Ignore the noise. Stop coming to value research online. Don't look at your portfolio. Don't look at the value. These are early days, and you will feel happy about it, and you will say thank you. Because when you start investing and the market is on a downward slope, you will feel happy, but you will feel happy a couple of years down the line. Because this is the best time. You're buying cheap, and you're buying cheaper, and you're buying even cheaper. We don't know how long, but generally market goes down and it also comes back. So you'll feel happy about it. Make sure that it's a long-term money. Somebody who started 2 years back and has been sitting on huge profit, and he's seeing his profit, what he made in a full month, now it actually slips in one day. For them, the lesson is that if you are in a diversified pool, and if you're on a SIP plan and you don't need the money, carry on with the plan. If you are likely to need this money in another 1.5-2 years, and you are very close to actually actualizing it, you are saving it for an objective with a goal in mind, take that money out. Take half the money out, so that you're not deprived of the opportunity because you got so close and now you're slipping back. Third is that somebody who is a long-term investor, he has accumulated sizable money, and you never implemented a rebalancing plan. You never worked on an asset allocation. You never decided that, okay, 25% of my money will be in fixed income. You never decided that 50% of my money will be in fixed income. And now you are regretful. Maybe use this opportunity to, create that 10% or 20% fixed income.
Okay.
Take that money out and be methodical about your rebalancing, because that is how you will be able to profit from these corrections, which will keep coming even in future.
Right. For new investors who want to enter the market, is this a good time to do that?
This is a great time, though it might look like a difficult time, but it's a great time because you are starting and you're buying cheap. You're buying 20% cheaper than what it was a couple of months back. And if it gets lower, feel happy about it. In fact, for majority of long-term investors who started, who carried on, you need to do some tweaking. But for a new investor, it's an excellent time to start. Also, you will have to follow one rule, that you are investing the money which you are unlikely to need for 5 years. Second is that in your first year, don't look at the values, just keep investing. Because it's very important to distract yourself from the noise. Because when you listen to all the things, the pessimists look very smart. When they actually make the claims about the doomsday and what will happen and the world will come to an end and Indians will be in trouble and the markets will collapse, it sounds very emphatic, it sounds very impressive. But optimists make money and pessimists sound smart. I've written a column on this on Value Research Online, look for it. They're very persuasive. The pessimists are very persuasive. Their rationale sounds very, very strong, but don't get carried by that. World improves every day.
All right then, moving on to the viewer's question. Renu Agarwal says, I have invested in 8 funds, 2 funds in each category. The cap-wise sum up of my portfolio on Value Research shows I have 60% in large caps, 31% in mid caps and 10% in small caps. Is this percentage of caps okay, or should I make any changes?
Oh, this percentage of capitalization breakup is fine. I would, and it doesn't make a difference, if the 60% gets, reduces to 50%, mid cap remains 30% and small cap becomes 20%. It doesn't matter, because, important thing is that broadly this is in line. This is a very well diversified portfolio. And in our own scheme of things, Value Research has a classification system. Before SEBI classification came in, we classified, and broadly that has been the spirit of the SEBI classification as well, which is, the large cap is 70%. We add up the market cap of all the companies in the country. And the ones which account for 70% on a cumulative basis, we sort them by the descending order. The companies which account for 70%, about 68, 70 companies account for 70%, they are large caps. Next 20%, which is another 130, 40 companies, they become mid cap. And the bottom, the bottom 10%, which is about, some 2,000 companies, which are somewhat actively traded, they become small caps. So small caps is a very large universe. Large cap is a smaller universe. And the SEBI classification is little different. But not radically on the spirit of it. That has been done for the calculation for implementability, for its ability. So, it's the top 100 companies are large cap. Next 150 companies are mid cap, and the rest of them are small cap. In Value Research, we have also classified something called giant and the micro cap. So the bottom 2% or 1% is micro cap. So they are tiny companies, sub 250 crore companies. This is a great, split of your classification, capitalization. This makes it a very well diversified portfolio. You should just keep in mind 2 things. Make sure that these funds are your funds are good. And funds are good, and I would like to give you a very simple definition of a good fund. If all these funds have beaten their benchmark over the last 5 years, that is it. And not necessarily every year, because the good funds will be able to beat the benchmark on a 3-year basis, 5-year basis, but not necessarily every year. But if it has not done it in the last 5 years, then worry about it. Then think of making those changes. Second is that, think of reducing the cost. Think of reducing the cost because of if you have large cap fund, just see that you have a large cap fund, because there are very few large cap funds which are able to beat the benchmark. So might as well, but having large cap actually gets you the stability of, improves the stability of your portfolio. Assuming that you decide to have 50% into large cap somehow, which will be coming from mid cap fund, because mid cap funds also invest in large caps. Small cap funds also invest in large caps, because the definition is done in such a manner that small caps are 65% into small cap. Mid caps are 65% into small cap. Large caps can be 80-90% into large caps. Rest could be elsewhere. So you could be getting this classification aggregated on Value Research Online for different reasons. This is a great thing. Make sure that you have good portfolios. Make sure that in the funds which are not there, you are substituting it with something which is lower cost index funds.
Right. Well, Renu, hope you've got your answer there. Now remember, just like Holi, markets are full of surprises, but don't be fearful of the splashes. Embrace them, diversify well, and stay invested for the long term. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thank you.